BASF is the giant chemical company of Europe. Headquartered in Germany, it already didn't have a good start since 2018, and the Russian invasion of Ukraine has hit the company hard, with revenue kinda stagnating since some time. You might think this company's not a buy, but I think there is a case for this company. If you look a bit deeper, they make money in different segments: chemicals, materials, industrial solutions, service and nutrition and care, agriculture. They're basically in everything. But all of this relies on chemistry, energy, and is heavy in capex. Now, what is the issue here? Energy. Most of their production is in Germany. So when Russia invaded Ukraine and energy prices shot up, gas prices and energy prices shot up. They had of course a pandemic effect, but afterwards they were slowly returning to profitability, and then invasion of Ukraine happened, energy prices went up, and profit margins heavily down. Now you might think, okay, great, this is a company with no moat, heavily positioned in Germany, where energy prices are just not worth it currently to produce. Plus the company currently has 23 billion in debt. Two things about this. The revenue currently declined. Yes, all of this is heavily reliant on the economy. So after the COVID boom, big spike, now it came down again. So we're in a low cycle currently in this industry. If we look at Dow, kind of a competitor in America, also spike after 2020 and down. We shouldn't look at this decline in revenue recently as a permanent thing. Moreover, is this company positioned to be good in the future? When you see, they're closing plants. They're heavily reducing their portfolio in Germany. So they're lowering their production in areas which is not profitable anymore, which will help them increase margins. Plant closure leads to less production, less revenue. How are they gonna compensate for this? BASF is currently heavily spending on capex. They haven't spent this heavy for quite some time. But where are they spending this? Capex per region? Mostly in Asia. The plants that don't make sense to run in Europe anymore, they're building up in China. And the plants in Europe that make sense, they're modernizing heavily to make them more profitable. Now, of course, for the short term, this is an issue, because while operating cash flow kinda stable over time, slowly growing, capex fastly growing right now. This massively ate up for free cash flow, currently only sitting at 1.8 billion. Not very great when you're paying out 3.1 billion in dividends. But once these plants are up in China, the European plants are modernized, this capex is gonna go way lower. They're currently generating 7.7 billion in operating cash flow during a cycle where this industry is not doing so well. Then let's say after this heavy investment phase, they go back to 2019. They reduce their capex by 2 billion. Not a lot. All the plans are done. They can go back to normal capex, and I think they would go even lower than 2019, because just a lot of investment has happened. There is not much need to modernize right now. Let's say they're going back to 3.9 billion. There would be nearly 4 billion in free cash flow. That on a market cap of 38 billion is less than 10 times free cash flow. During a low circle in the industry, there might be more short-term pain here, because this dividend is currently not sustainable. Like I showed before, they do not make enough cash flow to pay it out. This company is heavily held by German, especially, and European investors. And one thing you gotta know about us Europeans, on average, we like our dividends, and if a dividend gets cut, we heavily sell the stock. I would support them cutting this dividend so that they don't take on too much debt. If they slash it by half, they still have some extra cash flow after the dividend, and if that happens, the stock will probably crash by a bit. Let's see, how much would I be willing to pay at the moment? I would probably wait for until they cut the dividend. I haven't looked at the numbers yet when I would buy. In my guts, I just have a feeling right now that this company is a buy. We're gonna look at the price in a minute. I have a feeling BASF is gonna cut their dividend soon, just because it's not sustainable with the current free cash flow levels. They're gonna invest for a few more years, and I don't think they want to take on too much debt. I think they're gonna cut the dividend, then the stock is gonna crash probably, and then I would probably add it to my portfolio. But let's see, what would we pay with our assumptions. Now, if we assume that they get back to 4 billion in free cash flow, that is 4.46 per share. Now, what are our assumptions here? Once these plants are back up in China, they're gonna have a margin improvement to before, plus their revenue growth is gonna probably go back to around the industry average. So around 3% over the cycle, in line with the global economy, but a bit faster. That plus a bit of margin improvement, I would say 5% for the next 5 years. The margin improvement is gonna hit here, 4% after that. I don't assume any buybacks. This is a company that is probably, if they're gonna do buybacks, tiny buybacks, mostly dividends. Dividend payout ratio of 75%, with a slight reduction due to taxes. You can see the dividend is below what it is today, but that is because the dividend height is currently not very sustainable, and they're probably gonna want to reduce their debt a bit afterwards. So I just took it as this. Maybe it goes up to like 80%, maybe they're gonna pay out 90%, who knows. Multiple of 14, stable company, heavy presence around the world, top products, which was given us an intrinsic value of $59 per share. That is a 41% discount. So not at all a bad buy. I would say it's even a pretty good buy. If you're looking to have a reliable dividend payer, if you're not positioned in the industrial sector, I would definitely add BASF to my portfolio. Especially because if you look, what if it goes even better? Their margin improvements are going to be great in China. Higher revenue growth because they're positioned there, 7% and 5% after that. Higher multiple because it's a better company, faster growing, $75 a share. And now what if it goes really bad for this company? Basically, after the plans are done, no real free cash flow improvement, just 2%. That's all. That could be done in buybacks alone, if they only pay out this dividend. 12 multiple because it's a basically not growing company, $45 a share. Even here, you make a 10% return. So I will not add BASF to my portfolio currently, because I have better buys, but if I cut the dividend and it crashes, I can guarantee you it will crash at that point, I will add it to my portfolio. What do you think? Write down below. Have a good day.